Forex trading is the process of deciding which currency will strengthen and which will weaken relative to another. Every trade is based on this single comparison. The key question in Forex trading is simple. When should you buy and when should you sell a currency pair? This decision is made through analysis, not guessing. In this lesson, we introduce fundamental analysis. Fundamental analysis focuses on the economic forces that drive supply and demand for a currency. Changes in supply and demand move prices. Each currency represents a country or economic region. Fundamental analysis examines the overall health of that economy, including productivity, employment, manufacturing, trade, and interest rates. You do not need formal economics training. You only need to determine which economy is strengthening and which is weakening. Currencies tend to follow economic strength. In the euro to US dollar pair, the euro is the base currency. If you believe the US economy is weakening, the US dollar is likely to decline. In this case, you would buy euro to US dollar, expecting the euro to rise against the dollar. If the US economy is strong and the euro is weakening, you would sell euro to US dollar. This reflects an expectation that the euro will decline relative to the US dollar. In US dollar to Japanese yen, the US dollar is the base currency. If Japanese policy weakens the yen, the US dollar may strengthen relative to it. In this case, you would buy US dollar to Japanese yen. If capital flows back into Japan and demand for the yen increases, the US dollar may weaken. In this situation, you would sell US dollar to Japanese yen. In pound sterling to US dollar, the British pound is the base currency. If the British economy is outperforming the US economy, you would buy pound sterling to US dollar. If economic growth in the United Kingdom slows while the US remains strong, you would sell pound sterling to US dollar. In US dollar to Swiss franc, the US dollar is the base currency. If the Swiss franc appears overvalued, you would buy US dollar to Swiss franc. If US economic conditions weaken, the dollar may depreciate. In this case, you would sell US dollar to Swiss franc. Forex trades are placed in standardized sizes called lots. A micro lot is 1,000 units, a mini lot is 10,000 units, and a standard lot is 100,000 units. Leverage allows traders to control large positions with a smaller amount of capital. The capital set aside to open a trade is called margin. With a 2% margin requirement, a 100,000 unit position requires only $3,000 of margin. Leverage increases both potential profit and potential loss. A small price movement can produce a significant gain when trading larger position sizes. This is the effect of leverage. The same leverage that amplifies profits can also amplify losses. A relatively small adverse move can quickly eliminate trading capital. Positions held overnight are subject to rollover, also known as swap. Interest is earned on the currency bought and paid on the currency sold. If the interest rate of the purchased currency exceeds that of the borrowed currency, interest is earned. If not, interest is paid. Forex trading is driven by economic strength, position sizing, and risk control. Understanding these foundations is essential before progressing further.